Hello, this is Sky News. I'm Belle Donati with a special programme answering your questions on the interest rate rise. The Bank of England shocked economists and investors this lunchtime, raising interest rates to 5% to tackle inflation. But the Prime Minister says the situation is under control.
I am totally 100% on it, and it is going to be okay, and we are going to get through this.
The highest rate in 15 years means more mortgage pain for homeowners, but the bank's governor has defended the decision.
If we don't get inflation back down to target, then it goes on for much longer, and the pain goes on for longer, and none of us want that.
Ministers say they have full confidence in Andrew Bailey. We'll ask if he and the bank's Monetary Policy Committee are getting it right. And we'll be discussing whether the government will bow to pressure and intervene in the mortgage market. All that to come in the next hour. Hello and welcome to a special programme reacting to the Bank of England's decision to raise the interest rate to 5%. It means the rate is at a 15-year high, and it comes at a time of real concern for millions of homeowners. They face higher mortgage payments alongside a cost of living crisis that means higher prices because of inflation, the very thing the bank is trying to combat. So, in this hour, we'll be answering your questions about all the implications of this rate rise on your mortgages, savings and pensions, and all things personal finance with our panel of specialists. But first, the Prime Minister has tried to reassure people, saying this afternoon that things will be just fine.
Today, you may have seen what the Bank of England has announced with interest rates, and I'm sure that actually fills many of you with some anxiety, right, and some concern about what's going on and what does that mean for you and your families. Now, I'm here to tell you that I am totally 100% on it, and it is going to be okay, and we are going to get through this.
Well, the Labour leader, Sir Keir Starmer, says successive Conservative governments are to blame for economic failure.
We have to firstly think about all those families, all those mortgage holders who are going to be really struggling now in the middle of a cost of living crisis. Now their mortgage is going to go up as well, and they're paying the price. They are paying the price for 13 years of economic failure under this government. We haven't had growth significantly for 13 years. Add to that the mini-budget last year, which did huge damage to our economy, and the failure of the government to do anything about energy for years that would have kept our bills down. So now we've got the awful prospect of mortgage holders and families paying the price of Tory failure.
Well, let's bring in our economics and data editor, Ed Conway. Ed, the number was higher than was expected, but is this the sort of big, bold move that the Bank of England wanted to make to try and send a message?
I think from their perspective, it's all about showing that they are trying to get ahead of things rather than behind it. The big criticism of the Bank of England, you know, we've all seen what's happening with inflation, and you would have seen earlier on this week that inflation numbers, they didn't fall as the bank, as pretty much every economist had expected. They stayed up at that level of 8.7%. And more worryingly, from the bank's perspective, it wasn't just that overall number, it was the specific stuff. It's the fact that this is in services now. So we had that initial shock on energy prices, you had the initial shock on food prices, stuff went through the system, but the worry is that inflation can be quite contagious, and the worry is it's starting to become contagious. So it was the fact that it was core inflation that was going up, it's services inflation going up, and also doubly worrying from the bank's perspective. Also, you're starting to see wage inflation going up as well, and their fear is that then that starts to cause a kind of spiral which becomes very difficult to kind of bring back, which is why they've gone to quite dramatic standards. They have just raised interest rates by 0.5 percentage point rather than 0.25 percentage point. May not seem like that much difference, although if you have a mortgage, I'm sure you will notice the impact. However, it's worth saying that around the world, many other central banks are slowing down the pace at which they're raising interest rates. So the European Central Bank, the Federal Reserve, they're all, looks like they're kind of slowing down, getting towards the peak. In the case of the Bank of England, well, not long ago, it looked like maybe 4.75% was going to be the peak. Well, we're now through that. And a lot of people looking at markets at the moment, looking at money markets, think that it could be getting up to 6%. And of course, that's just the bank rates. You know, our mortgage rates are priced off what people in financial markets are kind of betting around the future path of interest rates. So it's slightly different. But even so, that path suggests significantly higher mortgage rates when you're coming in to refix. And that's the difficulty of where we are right now. There are hundreds of thousands of people who have mortgages due to be refixed right now and indeed in the coming months. And they will be a very big jump. They'll be facing a very big jump. Indeed, just looking at the numbers, the National Institute for Economic and Social Research, they are talking about potentially 1.2 million households becoming insolvent as a result of what's happening with mortgages. Their payments basically just getting so high that they can't finance them. So very significant pain going to be experienced. But it's worth just saying, for many households, those who don't necessarily have a mortgage, who have fortunately managed to pay it off already, it's not the same picture. And so what the government does about this, what the Bank of England does about it, and we just heard Rishi Sunak saying, I'm on it. Well, to be honest with you, it's mostly the Bank of England trying to deal with it. It's not entirely clear that the pain that many people are facing can be in any way diminished, because it is that pain that's the medicine. That's the unfortunate thing here. The pain is supposed to be the medicine. Brutal, definitely, blunt medicine, but it's supposed to be the medicine that brings inflation down. And unfortunately, for much of the UK, with inflation being high, and there are postmortems about why it's so high and whether the Bank of England could have done more earlier, but with inflation so high, they feel they have to do something about it. And that is kind of where we are today.
Ed, thank you very much. Ed Conway there, our data and economics editor. Well, let's get straight into your questions. We're going to start with mortgages, because that is the biggest part of the crisis is started. The mortgage crisis is the biggest part of this interest rate hike. With me to discuss mortgages first, Sky's business presenter Ian King. We're joined also by Laura Souter, who's head of personal finance at AJ Bell, and the mortgage broker Riz Malik. We've got a host of questions to get through from our viewers, and I'm really keen to get there. But I guess let's have an overview, first of all, Riz, probably from you, given it's mortgages. As a mortgage broker, how does it look out there right now? What's it been like over the last few months?
It's been exceptionally tough in the mortgage market over the last few months, especially the last few weeks. We have had the levels of volatility that I haven't seen for a very long time. We've had lenders coming into the market and repricing, usually giving us a few hours notice before they're pulling mortgage deals. Yesterday, when we saw the inflation data, we expected a rise equivalent to today. But I don't think it's going to get easier anytime soon, and there are going to be some very choppy waters ahead. I've been glued to my phone this afternoon, seeing which mortgage lenders are notifying us that they're repricing. I don't think there've been any as of yet, apart from obviously alerting us that trackers are going to change, because I don't think any lenders want to be first. But in the coming weeks, expect rates to be increasing on the whole.
Yeah, absolutely. Well, thanks, Riz. I tell you what, with that, let's start with our first question. This one comes from Greg. He asks, my fixed-rate mortgage is being renewed next April. What are my options? Riz, let's go to you on that first.
If it's being renewed next April, then it's probably a little bit too early to do anything. Usually, we're looking at 6 months prior to the expiry that we have mortgage offers that are valid for. So, for example, if your mortgage is expiring within 6 months, usually that's when we can start looking at things, because that's how long the mortgage offer that the lender will give you will be valid for. Now, there may be an argument for people to consider paying penalties, but if historically you're on a very low rate, I'd be surprised if there was any justification to come out of a deal to do anything as of yet.
All right. Laura, I'd like to come to you now. This is more of a personal finance questions, I guess, because it's from Lee, and he says, there's a possibility I will not be able to afford my mortgage now. What are my options? What would you say, Laura, to him?
So I think if you're in the position where you think you're going to miss your next monthly mortgage payment, then the best thing to do is to contact your lender straight away, which seems like quite a scary prospect, but it's definitely better to contact them before you've missed that payment and give them a heads up that you're struggling rather than afterwards. And there's quite a lot of things they can do. They can offer you a payment holiday for a number of months. They could look at extending the term of your mortgage, which lowers your monthly repayments, although it does cost you more over the long term of the mortgage. Or they could even move you to an interest-only mortgage. And there are lots of options, and the government is definitely putting pressure on mortgage companies to be lenient and to be more helpful for mortgage customers who are struggling at the moment. So definitely speak to your lender.
All right, thank you, Laura. Definitely worth speaking to your lender. I wonder, Riz, as a mortgage broker, How understanding are lenders given what's going on?
The lenders are generally understanding and sympathetic to people, especially those who are facing hardship at the moment. We do have the meeting that should hopefully be going on tomorrow with the Chancellor and the major lenders. So let's see what comes out as a result of that meeting. But generally, they are sympathetic if you are experiencing financial hardship. And as was just said, the sooner you speak to them, the better.
All right, thank you. Thanks very much, Riz. Ian, we've got one that's definitely for you, because this is now about banks. It's widening it out from mortgages. It's Janet. And Janet is asking, could banks change their criteria so that homeowners just have interest-only payments? So there we go. Banks changing their criteria so that homeowners just have those interest-only payments. How possible is that, Ian?
Yeah, absolutely, that's possible. And actually, UK Finance, which is the industry body for the UK financial services industry, has said that that is one thing that it wants lenders to consider doing when their borrowers come to them and they're struggling to meet their mortgage payments. So that is definitely something to be considered. Other possibilities include extending the duration of a loan as well, or offering forbearance, enabling borrowers to take a mortgage payments holiday in some cases. I mean, there are plenty of levers that the banks can pull to enable their customers to avoid getting into financial hardship, and I think you'll certainly see that coming. And incidentally, it's interestingly, Labour's Shadow Chancellor Rachel Reeves put out some proposals this morning, and that was one thing that she was very much calling for as well, giving borrowers the opportunity to switch to an interest-only mortgage facility on a temporary basis. And she's actually saying also it would that has to be at the discretion of the borrower, not the lender. In other words, when the borrower feels that they're in a sufficient position to start repaying the principal on their loan again, that they should be allowed to do that without too much difficulty.
Ian, I just want to come back to you on that, because we did hear from Rachel Reeves, Shadow Chancellor, setting out that plan to help mortgage owners. Same with the Lib Dems, who also want to put a policy forward to try and help out those who are going to see their mortgages rise. From an economic perspective, would that prolong the pain? Is it a sense that there's sort of a narrative that there needs to be a pain felt in order to get through this? Is that sort of economic, I don't know, wisdom?
Well, if you take those policies into, I mean, the Liberal Democrats essentially want a £3 billion fund to be set up to provide grants to people who are in particular levels of hardship. Of course, that is implicit in that is an element of government spending or government borrowing. Now, the Liberal Democrats are trying to hypothecate that on what they say are taxes that the banks have had, that their tax bill has been reduced since 2016. I mean, that's only true up to a point. Because the banks still pay a surcharge on their profits. That was reduced when the government raised corporation tax earlier this year. It was done in order to make the tax rate that the banks paid effectively neutral. So to talk about them having had a tax cut, they haven't really had one in that sense, although the banking levy has obviously come down very gradually as well. But implicit, I think, in the Liberal Democrats' proposal is more government spending. Now, the advantage of the Labour proposals, as they look to, is that they don't appear to imply any government spending. So I think that is probably why Rachel Reeves has put those forward. Don't forget, Rachel Reeves, not only did she work at the Bank of England earlier in her career, during the financial crisis, she was actually working at Halifax, the UK's largest mortgage lender, and she saw firsthand the distress that's caused when mortgage products are pulled from the market. So I think there was a bit of insight into those proposals. And as I say, coincidentally, they're pretty similar, what Rachel Reeves has said, to what the UK Finance, the industry body, has proposed as well. Does it prolong the pain? Well, yes, of course it does. If you move from if you move from a repayment mortgage to an interest-only mortgage, then that obviously pushes out the period that it's going to take to repay your mortgage down ultimately, unless you sell the house and trade down.
All right, yeah, thank you, Ian. Tom has a question. If our mortgages have tripled from £200 a month to £600 a month, where does that £400 a month extra go. Do you know what? I'd like Laura to come to you on this one, because it requires a bit of an explanation as well about how inflation works. But yes, so let's go through the numbers again. If the mortgages have tripled from £200 a month, they've gone up to £600 a month. And Tom's asking, where's that sort of difference, the £400 extra a month, going?
So essentially, as a result of interest rates going up, the Bank of England pushing interest rates up, that makes borrowing costs more expensive. Now, we've talked a lot about how mortgages, so the borrowing that individuals have, has got more expensive. But also, mortgage companies need to borrow that money to be able to lend it out to individuals, and their costs have gone up. So the amount that they can borrow and the rates that they're paying on that borrowing has increased. So essentially, it's pushed up borrowing costs for both companies, mortgage lenders, and ourselves. And then on top of that, obviously, mortgage companies are profit-making organisations, and so they are going to make some profit on top of that. So it's a combination of those rising borrowing costs from interest rates shooting up and a little bit of profit from the mortgage companies.
Riz and Ian, I've got you both raising your hand. Just because we've had Ian just now, we're going to go Riz first, and then we'll come to you, Ian. Riz, go on.
I was going to say, ultimately the rise in his monthly payment is due to the increased cost for the lender to acquire the funds, and it's been subsequently passed over to them. But there's one point that I really need to highlight here, and everybody really needs to get this. The Bank of England, their main role is to get inflation down to 2%. And today they've shown that they're very laser focused in doing that. The government and Rishi and Jeremy have said that they're not going to get involved. This is down to individuals to look at what they're paying out and seeing what deals they're on and really taking individual ownership here, because I don't think there's going to be any safety mechanisms here. If they have that meeting on Friday and they sit around the table and come up with some solutions like interest only, like payment holidays, all that's going to do is compound your debt. I think the key solution here going forward is if your payments are increasing or your lender has given you a proposal, say that they're increasing by a certain amount, go and shop around, because there are still deals out there in the market.
OK, that's a really interesting point. Personal responsibility is what I took, certainly, from that. Ian, you had a point to make as well.
Well, I mean, just to add on a point that Laura was making, I mean, when banks lend to homeowners, they'll either borrow that money in the wholesale markets, and as we saw in 2008, when the wholesale markets freeze up, it can be very problematic. But don't forget, banking is a fairly simple business when you boil it down. Essentially, you're taking in deposits from savers and you're lending money, some of which is those deposits from savers, onto borrowers and charging them an interest rate accordingly. And the turn you make on that is known as the net interest margin, NIM, and that is essentially how the banks make their profits. And when interest rates tend to go up, the spread, the NIM, actually tends to widen, which is why over the last 15 years or so, where we've had these ultra-low interest rates, it's been pretty bad for banking profitability. It's actually crushed banking profits. Now that you've got interest rates going up again, potentially the spread rises, and I'm sure you're going to have questions, Belle, later on about the extent to which institutions are passing on higher interest rates to savers. But if the banks are not passing on the full extent of these interest rate rises to their savers, then potentially the NIM increases for them as well, and so do their profits. So it's by no means cut and dried that they're necessarily having to absorb all of these costs themselves.
Responding to those questions as they come in. So I haven't had a chance to see if we've got one on that, Ian, but let's wait and see, and we'll certainly come back to you if we do. The next question from Ewan, this one requires a little bit of forecasting as to how long you think this inflationary period might last, or high interest rate might last. Ewan is asking, my girlfriend and I have bought our first house on a 2-year fixed rate. Will mortgage rates be better in 2025? Laura, let's start with you. Are things going to be better in, what are we now, 2 years' time?
I'm going to put the caveat in here that I think what we've learnt from this year alone is that forecasting interest rates and what the Bank of England is going to do is a nigh-on impossible task. But that's not very helpful to homeowners today. So what I will say is that we're expecting now interest rates to rise to around 6% by the end of this year. But crucially, I think when people think about interest rate rises, they then think about maybe them dropping immediately afterwards. And that's not what we're expecting. We're expecting them to stay at that level for for a decent period of time before the Bank of England starts cutting rates. So what mortgage holders need is not only for rates to stop rising, but also for them to be cut way back down to similar levels that we saw before they can get similar rates. And so I think anyone that's coming to remortgage in the next year, 18 months, potentially even 2 years, is still going to face those higher rates, because what we will have seen is the Bank of England has increased interest rates and then just left them at that 6% level if they get to that point, left them at that for a period of time before it starts cutting. What we need is inflation to start falling and falling meaningfully before the Bank of England will start cutting those interest rates.
Ian, I guess the markets are also going to have an effect on this. What's your view on that? 2025, where will we be?
Yeah, well, first of all, congratulations, Ewan. Happy homeowning to you. Obviously, it's a long-term game, this. If you look at what the money markets are predicting, there are certainly going to be no interest rate cuts this year, or as things stand, the market is not pricing in any interest rate cuts next year. And in fact, we're obviously expecting further interest increases during the duration of the rest of this year. By early 2025, it's possible that rates might start to be coming down again. But we're not looking at, certainly not a sharp deceleration in borrowing costs in the way that we've seen an acceleration in borrowing costs since the end of 2021, when the Bank of England started raising interest rates. So it's very possible that, certainly according to the money markets, that interest rates will start to be coming down probably by mid-2025. But as Laura said, there's a massive caveat involved in that. And we are where we are here today. One of the reasons we are here where we are today is because wage inflation in particular, and also consumer price inflation, is at a higher level right now than the bank was even forecasting a month or so ago.
Riz, what about you? What would you be advising Ewan? He's on a two-year fixed rate. What would you say to him about what happens when he comes off that?
When Ewan comes off the 2-year fixed rate, it all depends on what the world's going to look like at that time. Something I would like to add, though, is that we would also like to see some more financial innovation from the mortgage lenders. Now, fixed rates have been very popular since 2008, when interest rates have been touching the floor. However, there are other types of mortgages out there, and I think we'll start seeing the re-emergence of the discount, which hasn't been as popular as it was prior to the credit crunch. So there are other mortgages out there. Yes, it's understandable that with the rate rising environment, fixed rates are an option, but it's really important to sit down and see what your aims and aspirations are, and ideally get advice to see what's the best route for you to go down.
OK, thanks, Riz. Well, we've heard that from Ewan. He, obviously, a first-time buyer, already bought. We've got another question here from DCH, who's asking, my partner and I want to buy a home together, so haven't bought it yet. Neither of us have debts. Is it worth buying in the current climate? So a wider question there about whether, actually, it's better to stay as a renter in this environment, or whether it's better to try and pull together the money and purchase and get involved in a mortgage. Laura, what would you advise?
So I think there's probably two sides to this. There's the financial side of it, and then there's the lifestyle side of it. So on the financial side of it, some people are predicting that maybe this crunch on mortgage rates might have an impact on the housing market and could potentially lead to house prices falling. But that's so hard to predict. And actually what I think probably is of more importance to first-time buyers who are planning to buy a property and live in it for a decent amount of time, not just kind of live in it for a year or so and flip it for a profit. What's more important to them probably is having a roof over their head that they own, and being able to paint the walls the colour that they want to, and not being beholden to a landlord who might increase rents. And so I think if it's a lifestyle factor that it's really important to you to own your own property, then attempting to time the market and time the housing market and interest rates at a certain point in time is really tricky to do, and the experts fail to do it a lot of the time. And so I think it's more worth thinking about your lifestyle, what you want to do, where you envisage yourself living for the next 5 years, and making that longer term commitment. And I think a lot of what we've talked about here is homeowners and the impact on them. But renters are really being clobbered by this rise in interest rates. We've seen a reduction in the number of rental properties on the market, and then landlords passing on these increasing mortgage costs to renters. And so that's such a tricky market to be in, and it's really hard to find affordable rental properties. And so for people that want to get out of that market, market and don't want to risk that they're going to get handed kind of their eviction notice or have to move or have to pay suddenly higher rent, then buying a property may well be a much better move for them.
It is such a unique market, the UK property market, unlike its European counterparts. I've got a question here from Kaval, who's asking, do you think the interest rate hikes, along with a decline in mortgage applications and home sales, will have an impact on young people's futures? I mean, this really talking about who is going to suffer the most in this inflationary interest rate hike environment. Ian, what is it like for young people? I mean, we know that those in their sort of 30s looking or just having bought a house are suffering the most at the moment in this part of things. So what would you say to Kaval? I'll just repeat the question. Do you think interest rate hikes, along with decline in mortgage applications and home sales, what impact will that have on young people's futures?
Well, if you're talking specifically about house prices, then you have to assume that there is going to be some sort of decline in house prices implicit in all of this. Once people do start to struggle to keep up with their mortgage payments, it's going to put a damper on mortgage activity. Potentially, in a worst-case scenario, you could see some people even selling to get out of the position that they're in and extract some capital that they've got in their house and go back to renting. But as you say, the renting market is incredibly tough right now. Yeah, I mean, I've got to be very careful here, Belle, because whenever we answer these sort of questions, I will get inundated with people saying, well, I remember paying 15% on my mortgage all those years ago. And yes, indeed, they did. I mean, I certainly paid 8 or 9% at various points in the past, never went as high as 15. But people forget back then, housing affordability was much more modest in those days. Yes, interest rates were much higher, but it was much easier to get on the housing ladder back in the 1980s than it is now. So people need to bear that in mind. And I think younger people, yeah, they have a really, really tough time of it, particularly anyone who has graduated or gone into university since the introduction of tuition fees. They're already paying effectively a hypothecated graduate tax on their earnings unless they're not their earnings don't go above a certain threshold, and they're paying a pretty punitive rate of interest on that. So I think older people like myself probably need to have a good deal more sympathy for the young in this respect.
Well, we heard it here first. Thank you very much. Ian King, our business presenter. Ian, I know you're going to stay with us for the rest of the programme, so thank you. But we're going to take a short break, and I'd like to thank, before we do that, Laura Souter, Head of Personal Finance at AJ Bell, and mortgage broker Riz Malik for their interventions, their thoughts. I hope you found it useful. Coming up after the break, plenty more. We will be joined by the former Pensions Minister, Baroness Altman, to discuss the impact on savings. Stay with us. Hello and welcome back to our special programme answering your questions about the Bank of England's interest rate rise. That rate now at 5%, the highest it has been in 15 years. In this section, we will be looking at how the rise is affecting savings and pensions. Well, still with us to discuss that is our business presenter Ian King. Joining us also is the former Pensions Minister Baroness Ros Altman and our economics editor Ed Conway. Well, let's get straight into your questions on this. It's lovely to have the three of you. Thank you very much for joining us. I know you are there in audio, if not in vision just yet. Let's begin with a question from Mark. Mark asks, oh, there you go, lovely. Thank you very much. I'm very glad to be able to see you all now with us. Let's begin with a question from Mark. Are high interest rates good for pension pots? Ros Altman, let's start with you on that.
Now, high interest rates are better for annuities. Annuity rates have increased by probably over 20% in the past year, which is a significant rise. But that only helps you if you're buying an annuity. Unfortunately, many people who are reaching retirement are finding that their pension company invested much of their money in bonds, and that performance has been terrible because the higher interest rates go, the more money they lose on their bond investments, and they were supposed to be safe. So higher interest rates is very bad news for pension savers. It doesn't help people who've already started taking their pension in the form of annuity, but it might help people who want to lock into an annuity at current better levels. But of course, we don't know what's going to happen to interest rates next either.
Well, I guess that's an interesting question, because I guess those pensions companies, will they now, in terms of how they're investing, be changing to much safer? Ian, this is one for you. Will they be changing their investment strategy into much safer assets?
Well, don't forget you're talking here about defined benefit pension schemes. In other words, where the employee doesn't bear the risk of market movements, but the employer does. They're pretty rare in the private sector now, and where those schemes do exist, though, you've essentially seen, because so many of these former schemes have closed to new members, essentially they're running out of members because there are no new members coming in. So it gives the scheme sponsor a very good idea of their liabilities, in other words, the payouts that they're going to have to make to future retirees, and accordingly they're going to manage their assets in line with that. They will try and match their assets with their liabilities, and as Ros says, a lot of these scheme sponsors have just done that by buying bonds. One point that it's worth making, going back to the original question about higher interest rates. So one thing that higher interest rates do, it's quite a complicated process, which I won't go into the weeds of, but essentially higher interest rates tend to have the effect of reducing pension scheme deficits. So that is potentially very good news for scheme sponsors and the shareholders of those companies.
All right. Ed, would you agree with that? I mean, high interest rates, on the face of it, you'd think great for savers, but you know, what we're hearing is it's much more complicated than that when it comes to pension pots.
Yeah, and I mean, like, you know, obviously it is worth just underlining often when we tell these stories, I don't know if it's just the kind of composition of people who work within the media, but we do focus perhaps unduly on people who have mortgages, but it's worth just saying, you know, of the people who own their homes around the UK, actually today, and this is an interesting shift from where we were back in the 90s. Ian was talking earlier on about the 90s and how it's difficult to compare those kind of higher interest rates that you had back then with the rates that ostensibly are lower now, but the impact is potentially higher or kind of equal. Well, the different change that's happened since then is that there are more people who own their homes without a mortgage now, and therefore, if you're talking about the impact of higher interest rates or indeed lower interest rates, it's just as, if not more important, to focus on those who have already paid off their mortgages and who are net savers and potentially are coming into taking out annuities at the moment. Now, in theory, of course, things should be much better for those who aren't necessarily in debt, with interest rates going up. The problem, of course, is that banks haven't necessarily been quick to pass on those higher interest rates. It's always the way. They always, tend to yank them up when it comes to the borrowing rates, but not yank them up half as quickly when it comes to those savings rates. And that's one of the things that I know that the Chancellor says he wants to talk to the banks about. But, this has happened time and time again. They haven't passed it on very quickly. And there are question marks. The one area, by the way, where there has been very quick pass-through, and this is a different issue, but it's no less important, is for the government. So due to just the intricacies of the way that quantitative easing, this big policy, which, I know both Ian and Ros have lots of thoughts about. This is the policy whereby during the financial crisis, the Bank of England pumped a lot of cash into the economy when interest rates got down to zero. Well, the reversal of that, due to all sorts of mechanical factors, means that the interest rate that the government is facing goes up quite quickly every time the Bank of England raises it. So there's also a separate story here. It's not just about the savers, it's not just about borrowers, it's not just about that, but it's also about the government. Suddenly, the government's leeway for spending or for borrowing in the future has just gone down because its room for manoeuvre within its rules has been eroded as well, which is another factor. Less room for tax cuts, even as, a lot of people are looking at the economy and saying all of these factors mean there could well be a recession coming up.
That's very interesting, Ed. I'd actually like to come back to Ros Altman on part of what you were saying just there at the end, because we did hear the Prime Minister, Rishi Sunak, earlier talking to workers at an IKEA factory in Kent. And there he was talking about the difficult decisions that he has to make and hinting at this sort of, as you said, the margin for movement there decreasing. I wonder if you think, and let's be clear, Rishi Sunak has perhaps not supported, but at least supported the Bank of England's independence in making its decision on interest rate rises. Ros, do you think they're the right lever to be pulling? Are there any others? Because at the moment, monetary policy relies just on interest rates. What else could be done? Is there anything else?
Well, I do actually think we need to question just how effective keeping on interest rate rises is going to be in terms of combating inflation. The theory is that the more you push up interest rates, the more you are supposed to encourage people to save rather than spend. Now, the problem at these levels of interest rates is, although they've gone up so much, they started from such a low base and inflation has reached such a high level that it still doesn't really pay you necessarily to save. You might be better off spending today because prices are rising faster than the return you get on your savings, which are eroding in real terms. So if the central bank was to really try to use this mechanism properly to bear down on inflation and stop people from spending instead of saving, rates would probably have to go up beyond where the inflation rate currently is to make it more attractive for savers. And that itself is likely to cause a significant weakening of the economy, most likely a recession. Now, some people say we've got to have a recession if you want to get rid of inflation anyway. I'm not so sure that the automatic mechanisms that we're going to see from the statistical base effects of last year won't be able to bring inflation down. The Chancellor is certainly very confident that inflation will come down, and it should, because a lot of the raw material prices that were soaring and the energy costs that were soaring in the second half of last year are now much lower than they were, and some of them will very much help reduce the inflation rate. The problem is that we've had years and years of central banks forcing interest rates down artificially by creating new money out of thin air, basically. That's what quantitative easing does, and using that to buy bonds to force interest rates lower and encourage people to borrow more and spend more to get the economy going. Now, the opposite of that, which is where we are heading now, means that you have to mop up all that extra money. That takes money out of the economy. If you try to do that without create a recession, then actually inflation is likely to be higher than the Bank of England's target. And that's where I think the risk is, that we're heading for some kind of stagflation where the economy is not that strong. Inflation doesn't come down enough. The Chancellor's still only talking about getting inflation down to 5% or so by the year end. And that itself may embed inflation expectations into the economy. And it makes the central bank's job much harder because the extent to which they need to push rates up is so draconian that probably is politically unacceptable anyway.
Yeah, OK. I want to get time to come into Ian and Ed on that, but let's just go back to the questions very quickly because we have one from Jay. Have interest rates gone up for savings accounts? Now, we've been talking about this, obviously, within the context of pensions. I mean, I could probably answer part of this question for Jay. Let's hit it over to Ian, though. Have interest rates gone up for savings accounts? And let's have a little bit more on why and how.
Depends on who you're saving with, to be perfectly honest, Belle. And obviously the old hard and fast rule still holds true here, that the longer you tie your money up, the better return you will get on it. So for a lot of notice accounts, there are still some pretty good deals out there. It really depends on who the lenders are. I mean, if you talk to someone like NatWest, for example, they're absolutely adamant that they've been passing on pretty well as much of the increases in bank rate that they've been able to. Perhaps no coincidence that they remain more than 38% owned by the UK government. Nationwide and Mutual, with no shareholders, have been pretty assiduous. And there are plenty of options out there for people looking at yield. I noticed that overnight, National Savings and Investments have raised the interest rate on the premium bond fund to 3.7%, which is the highest that's been for 15 years. And if you're looking for yield, don't just think about savings account, think about shares as well, think about equities. Now, I'm not allowed to give investment advice, clearly, but there are a clutch of really, really solid FTSE 100 companies paying very attractive yields, the likes of British American Tobacco or Imperial Brands. I mean, a lot of people might think, well, I'm not going to buy shares in a tobacco company. So, but those have very, very attractive yields right now for people who are looking for an income from their investments. Lloyds Banking Group, it's yielding more than 5% right now. So don't just think, when you're looking for a return on your savings, don't just think about savings accounts. Think about perhaps the equity market as well.
Other banks are available. I feel obliged to say, Ian, thank you. Ron is asking, will the banks pass this rate rise on to savers? They have failed to do so this far. Of course, something that Ed was talking about earlier, the banks failing to pass on that rate rise to savers. Ros, do you think they will, and how quickly?
Well, certainly the big banks have been very slow to keep up with the rate rises. They've increased people's borrowing rates far more than they've helped savers with higher rates. Some of the smaller banks, the challenger banks, have actually got better deals. So it definitely pays to look around. But none of the savings rates will beat inflation. They are all significantly behind. And as I say, that itself may put people off building up the savings that will help perhaps see them through if there is a recession. However, I think that the banks are increasing profit margins quite significantly at this point. They've taken the opportunity, like perhaps some other companies in the goods markets, food and so on, have done. If people are expecting rates to go up, they can push up mortgage rates more perhaps than they otherwise might and get away with it. And that's the kind of conversation that I think the Chancellor is having now with the banks to try and redress that balance.
All right, thank you very much. Well, that is the end of this particular section on pensions. I'd like to thank Ian King, our business presenter, and our economics and data editor, Ed Conway, who are both going to stay with us for the next part of this Q&A programme. Baroness Ros Altman, former Pensions Minister, thank you very much for having joined us. It's been great to get your thoughts. Thank you. Well, the Governor of the Bank of England said today raising interest rates is the right way to deal with soaring inflation. But he's facing criticism for downplaying inflation over the past 2 years. Some economists are claiming that he should have foreseen the current issues. So who's right? Well, let's dig into that. This time for our next section, we're joined by Andrew Sentance, former member of the Bank of England's Monetary Policy Committee. It's lovely to have you with us. Thank you very much. That was a very quick turnaround from our previous guest. Thank you. I'm going to go straight into our questions. This is a viewer Q&A, so let's have our first question, which is from Kim. Kim asks, how is raising interest rates going to stem the profit price spiral that is driving inflation? Let us begin, Andrew Sentence, let us begin with you on that. So this profit price spiral, why is it that interest rates is the lever that's pulled on these things?
Well, the inflation that we have in the UK is being supported by the fact that demand measured in money terms, not necessarily in real terms, but in money terms, is increasing too rapidly. And a very sort of good characterization of inflation is too much money chasing too few goods. So what a policy of raising interest rates does is to curtail the growth of money spending, and over a period of time that bears down on the rate at which companies can increase their prices, and also on the rate at which companies are willing to increase the pay of their employees, which then is something that can feed through into inflation. Now, there are other effects that you get from raising interest rates. For example, raising interest rates can help push up the value of the pound, and that could help curb some of the imported inflation. But the main way in which economists believe raising interest rates contains inflation is by limiting the rate of growth of money spending and demand in the economy.
OK. Ed, are there other ways of doing the same thing?
Well, it's worth just, I mean, so you know, part of the premise of the question is about this kind of profit price spiral that's driving inflation. I mean, there is some research and some evidence that part of what's driving inflation around the world is that companies are increasing their profit margins. It's worth just saying there's much more evidence of that in the US and in the Eurozone than in the UK. It's a part of it in the latest quarter, but for the most part, you know, basically it looks like we've had a massive energy price shock. That is the main thing that's happened in the UK, a supply shock. And that has been a massive blow for many people in this country. And that now looks like it's converting into something else, and that's kind of where the next step comes in. So prices go up of things like food, of things like energy, because you know food prices are related to energy prices. You need a lot of energy to make food. And then that in turn means people start to get used to those high prices, and then that turns into higher inflation that's kind of embedded within the economy. And the worry there, and this is something that Andrew Bailey, the governor, talked about today, is that, first of all, if wage price inflation, so it's entirely rational that everyone asks for higher pay settlements given they're facing higher costs in the supermarket. But if you start to see that kind of spiralling and one chases the other, then it's very difficult for the Bank of England to chase it. By the same token, he sent out a warning as well to companies as well, and said that companies should not be raising their profit margins unduly at the moment. But so there is definitely an element of it, but I wouldn't say it seems like the main dynamic right now that's going on in the market. It looks like a price shock has led to this kind of this contagious inflation, and then as a result of that, the Bank of England is bearing down on it. And then we can talk about the extent to which the bank is actually going to be able to get on top of that. But it's not just, I mean, some people have called it greedflation. It's not just greed inflation. There's a bit of evidence of that, so it shouldn't be ruled out. And companies are kind of rebuilding profit margins. But it doesn't look like that is the main factor at the moment.
And is there something unique in the UK and the way the UK has been dealt different blows at the same time that has meant that comparably it's not looking great to other countries, that is?
I mean, it's not, I wouldn't say it's unique because, you know, there are many countries around Europe facing not totally dissimilar levels of inflation. But, you know, if you look at the G7, so that's only 7 countries, it's not exactly representative, but it's a traditional grouping a lot of people look at. The UK is the highest. And I think the worry is more lately, our inflation rate, particularly the core inflation rate, does look like it's kind of getting a bit out of whack with other countries. It's a bit too early to tell whether we're kind of really flying away, but certainly, you know, we're not exactly unique. What's definitely true is that we always seem to be on the upper end. We were on the upper end, so basically the highest in the G7 when it was in the 60s and the 70s. We're on the upper end now as well. And you can kind of point to all sorts of different factors, and many of them seem like they're legitimate explanations, whether it's the fact that we're more exposed to energy. We have a higher proportion of people with gas central heating, and obviously gas prices went up a lot. Brexit as well has contributed in various different respects, according to many anecdotes. But the issue is, it seems, traditionally just to be the British thing. When inflation happens, we seem to just get it a little bit higher than most other countries around the world. And history seems to be kind of repeating itself all over again.
OK. We've got another question, this time from Nick. Is a forced recession the only way to bring inflation down? Andrew Sentence, I'd like to come to you on that. I mean, we've heard that idea being expressed by, well, several, former Chancellor Norman Lamont, for example, that perhaps what we need is a short, sharp recession to bring down the levels of inflation.